Total debt relative to disposable income is lower than it was a year ago, but still high by historical standards. Despite lower interest rates, signs of financial stress have risen over the past 12 months, particularly in households without a mortgage. For example, the share of these households that are behind on credit card or auto loan payments has continued to go up. Among households with a mortgage, about 60% are facing renewal this year or next. Most of those renewing will see their payments rise because they took out their mortgage during the pandemic when rates were at historic lows. But the average increase in payment will be smaller than we expected a year ago. Still, if a large shock causes job losses, it'll be harder for some households to keep up with their debt payments. A prolonged trade war may be that shock. It would cause demand for Canadian exports to fall. It would disrupt supply chains, threatening jobs and incomes. Workers in trade-dependent industries could find it particularly difficult to continue managing their debt. A prolonged trade war would also matter for businesses. Most Canadian businesses have managed to adjust to past interest rate increases, and the surge in small business insolvencies last year proved to be temporary. But businesses in trade-related sectors, especially those with high debt, low profitability or cash reserves, could also fall behind on debt payments. A strength in our financial system is that Canadian banks are well positioned to absorb higher credit losses. Banks have increased their capital buffers in recent years, and more recently they've also increased their provisions for credit losses, and these both bolster their resilience. Liquidity levels remain high, and access to funding for banks is also good. But if credit losses occur on a large enough scale, banks could cut back on lending in response. Struggling households and businesses would then have less access to credit to get through tough times. This cycle could exacerbate the economic downturn. In the non-bank financial sector, the growing presence of hedge funds in the market for Government of Canada bonds raises some concerns. Government bond markets are the foundation of the financial system, and they need to function smoothly for all other markets to work well. The increased activity by hedge funds has helped absorb increased issuance of government debt, keeping yields lower and liquidity higher. But hedge funds have also taken on increasingly large amounts of leverage to fund their purchase of government bonds. And this makes them more likely to pull back from these crucial markets in periods of stress, introducing added volatility. The recent gyrations in the U.S. Treasury market clearly illustrated this risk. If the trade war causes a larger spike in volatility than we've seen so far, leveraged hedge funds might rush to sell their holdings. That could strain liquidity across core markets, increasing stress throughout the financial system. Moreover, the growing connection between banks and non-bank financial institutions could make it easier for stress to spread. Against that backdrop of increased market volatility, and given their importance in the government bond markets, hedge funds need to make sure that they're prepared to respond to sudden liquidity needs without disrupting broader market functioning.